Everyone was waiting for it. The blow-off top. The face-melting, parabolic rally that was supposed to send Bitcoin screaming past $200,000 before Christmas 2025. We were promised a super cycle. We were promised the God candle. We were promised one last vertical move that would erase every doubt and reward anyone who held through the chaos. Instead, what did we actually get? A brutal 30% drawdown. Extreme fear flashing across sentiment gauges. And for a lot of portfolios, a very uncomfortable holiday season. If you're staring at your holdings right now wondering how the narrative flipped so fast, you're not alone. The legendary Q4 rally never showed up. No fireworks, no Santa rally, no euphoric finale. So that raises a serious question that crypto investors have avoided asking for years. Is the 4-year cycle finally dead? Has the halving lost its power to drive exponential moves? Or has the market evolved into something entirely different? Something that requires a completely new strategy if you want to survive and thrive in 2026? That's exactly what we're breaking down today. Why this cycle failed to deliver what everyone expected. Why smart money isn't panicking, but quietly repositioning for 2026. And how you may need to rethink your exit strategy before the next phase begins. You'll want to pay close attention to this one. Welcome to Web3 Verse. Before we go any further, a quick disclaimer. Nothing in this video is financial advice. This is for educational purposes only. Crypto markets are volatile, unpredictable, and influenced by forces that change fast. Always do your own research and manage your risk. Alright, let's talk about where we actually are. As we close out 2025, Bitcoin is trading in the mid-$80,000 range. Now on the surface, that still sounds impressive, especially if you bought during the depths of the last bear market. But context matters. We're more than 30% below the all-time high set earlier this year. And more importantly, Q4, historically the most bullish quarter in crypto, has turned into one of the worst fourth quarters we've seen since 2018. That should immediately set off alarm bells. For over a decade, the 4-year cycle has behaved like clockwork. A halving event, a delayed supply shock, and then a euphoric peak toward the end of the following year. It worked in 2013. It worked in 2017. It worked again in 2021. So naturally, the entire market positioned for a late 2025 top. Funds, influencers, retail traders, even institutions. And then, Bitcoin topped months early. So what broke the cycle? The answer starts on Wall Street. Spot Bitcoin ETFs didn't just add demand, they rewired how this market behaves. Since launching, they've absorbed hundreds of billions of dollars in capital. That institutional demand helped push prices higher, no doubt. But it came with a cost. Volatility is disappearing. Early Bitcoin cycles were dominated by retail investors. Retail buys emotionally, chases green candles, and piles in all at once. That's how you get vertical rallies and brutal crashes. Institutions don't behave that way. Pension funds, asset managers, and corporate treasuries don't FOMO. They allocate. They rebalance. They buy weakness and trim strength according to models, not emotions. That constant, mechanical flow of capital smooths price action. It caps the upside, but it also cushions the downside. That's why we didn't see an 80% collapse. Instead, we saw a controlled, painful, but orderly drawdown. The ETFs didn't just absorb Bitcoin supply. They absorbed the cycle itself. But that's only part of the story. The other major factor is global liquidity. Historically, Bitcoin thrives when central banks are flooding the system with money. Loose liquidity equals risk-on behavior. And in 2025, liquidity was tight. Interest rates stayed elevated. Capital was expensive. Central banks were actively draining money from the system. Bitcoin still rallied, largely due to institutional inflows, but by late 2025, liquidity pressure finally caught up. The traditional Santa rally never arrived because there simply wasn't enough easy money left to fund it. But here's where things take a turn. At the end of 2025, that liquidity drain stopped. And historically, when tightening ends, expansion follows. Which brings us to the most important shift you need to understand. If the halving cycle no longer defines market tops, what does? The answer appears to be the liquidity cycle. When you overlay Bitcoin's price with global money supply, the correlation is striking. Bitcoin doesn't peak when the halving calendar says it should. It peaks when liquidity does. And according to global liquidity models, that peak isn't behind us. It's projected for mid to late 2026. This is why many institutional analysts believe the cycle didn't fail. It stretched. Instead of a violent blow-off top, We're seeing a slower, more sustained grind higher. The rally started earlier than expected, paused in late 2025, and may resume in 2026 as liquidity conditions improve. This view isn't coming from crypto influencers alone. Major banks, asset managers, and macro analysts are aligning around similar projections, placing Bitcoin's eventual peak well into 2026, not 2025. The market is transitioning from boom and bust to grind and hold. So what does this mean for you? It means the old playbook may no longer work. If you're waiting for a single, obvious blow-off top, a day where Bitcoin goes vertical and altcoins melt faces, you might be waiting forever. That signal may never come in this lower volatility, institution-dominated market. Instead, adaptation is key. First, stop watching the calendar. Watch liquidity. As long as global money supply is expanding, the broader trend remains intact. Second, focus on on-chain metrics rather than price alone. Cycle tops historically occur when valuation metrics reach extreme levels. Right now, those indicators suggest we're dealing with a mid-cycle correction, not the end of a bull market. And third, and this is critical, stop trying to time the perfect top. In this environment, gradual exits often outperform heroic guesses. Scaling out as the market grinds higher protects you if conditions reverse, while still keeping you exposed if the upside continues. The era of one perfect sell candle may be behind us. Now let's be honest, this hasn't been easy. A red Q4 hurts, especially when expectations were sky high. But when you zoom out, the core thesis hasn't broken. Supply remains constrained. Institutional demand is real and sticky. And macro conditions are slowly shifting back in crypto's favor. The 4-year cycle as we knew it may be gone, but it's being replaced by something potentially more powerful. A mature, liquidity-driven secular bull market. The easy gains of the early days may be fading, but the era of serious capital is just beginning. So the real question is this: do you believe the cycle is dead? Or are we simply catching our breath before the next phase begins in 2026? That's the conversation we're having here on Web3 Verse. Thanks for watching.